Welcome to ForexTV.com. Today is Tuesday, November 25th. I'm Kathleen Reddington with your New York Forex Market Buzz. The Japanese yen gained on the euro and the dollar for the first time in 3 days. And now for a look at the latest headlines from the CEP News Desk. The S&P Case-Shiller U.S. Home Price Index fell more than expected in September. The 20-city composite index posted a 17.4% decline, extending August's 16.6% fall. The Case-Shiller index has fallen every month since peaking in July 2006. U.S. GDP came in as expected for the third quarter of 2008, contracting by 0.5%. Personal consumption, which accounts for 70% of the GDP in the U.S., fell by 3.7% compared to the original estimate of a 3.1% contraction. The U.S. government announced today that it will spend $600 billion to take on the obligations of Fannie Mae, Freddie Mac, and Ginnie Mae in order to reduce borrowing costs for the government-sponsored enterprises. And Canadian retail sales raced past economists' expectations in September to total 36.3 billion Canadian dollars, posting the largest monthly increase in 8 months at 1.1%. Economists had anticipated strength in auto sales and gas stations would push up the overall number, but even excluding autos, retail sales rose 0.8%. Excluding gas station sales, retail sales rose 0.6%. Today we are joined by Greg Michalowski of FXDD. Hi Greg, how are you today?
Doing well, Kathleen, thank you.
All right, so yesterday we had the Fed bailing out Citigroup, and then today they announced that they'll spend roughly $600 billion to assist housing markets and housing spending. Do you think all this spending is necessary, and how will this new plan either help or hurt?
Yes, I do think it's necessary, and I have some charts to help support that view. If you recall, yesterday we had the existing home sales come out, and they came in at a $4.98 million annual pace. On the chart of existing home sales, this equates to sort of roughly the 2000 to 2001 sales pace. This is an indication of demand for housing in the United States, and clearly the demand is down at these lower levels. Now let's take a look at the supply. And with the existing home sales, they also release a month's supply of homes on the market. This chart on the supply shows that the existing home sales on the market equals 10.2 months supply of houses. Now let's compare that to the 2000-2001 area. Actually, it goes to 2005, and the supply of homes on the market was the equivalent of 5 months supply. So we have demand that's down at 2000-2001 levels, and we have supply that's twice the amount that existed in the 2000-2001 level. So the final piece of a supply-demand chart is the price of homes, and this final chart shows the median sale price of the existing homes that came out yesterday as well. And if again we go back to the 2000-2001 level, the median sale price was around 145, maybe 150,000. Yesterday, the median sale price came down 8,000 in 1 month to 183,000. So demand says that the demand is low. The supply says that supply is high, and the price says that the price is much higher than it was in a period where in 2000-2001 where the demand was the same. So all this suggests to me that the house prices have to decline, and this is what the Fed is certainly worried about. Let's look at another final chart here, and this shows the 30-year mortgage rate, the 30-year Treasury yield, and the spread between the mortgage rate and the Treasury yield. The red line represents the 30-year mortgage rate. That's currently around 6%. The blue line represents the 30-year Treasury bond. That's currently around 3.63%. The green line shows a spread between the mortgage rate and the Treasury yield. That line is near the top of its range. In fact, it's at the top of its range. This is what the Fed is worried about. The lowering of the yield in Treasuries and the lowering of rates by the Fed are not getting to the consumer. And the reason why it's not getting to the consumers are previous charts. The banks are worried about the price of housing going down. So the Fed and what the Treasury is trying to do today is pump liquidity into the mortgage market to take on some of these mortgages from Fannie Mae and Freddie Mac, so that lending opens up, and we see the rate of mortgages come down, and the spread between the Treasury and the mortgage rate to come down, because it's the consumer that needs the help. If the consumer is going to, if they can't refinance their mortgages, if people can't get a mortgage, then the housing market is going to continue to weigh on the economy. It's going to hurt retail sales. It's going to hurt employment. This is going to cause banks, the price of housing to go down, and the banks to be under pressure still. And so this is what they announced today was a direct hit on the mortgage rates. And hopefully over time, over the next week, maybe 2 weeks or something, we're going to see the mortgage rates start to come down to levels that will hopefully stimulate demand in housing and allow at least people to refinance or not foreclose on certain loans.
All right, now talking about currency a little bit, the yen was recently up on the euro and the dollar in some recent trading based on global recession fears. But earlier, after the announcement by the Fed, we saw the dollar up on the yen and down on the euro. Do you think we'll see that whole scheme of things, yen, dollar, change a lot during the day-to-day, or will the higher yen trend continue?
My opinion of the dollar yen, if you actually look at the chart, and here, I've provided a 4-hour chart. It's been very volatile, up and down, with a little downward bias as far as the dollar yen goes. That is probably more in reaction to the cross currency pairs getting sold off as the stock market sells off. But of all the major currency pairs, the dollar yen is one of my least favorite right now, only because it's so volatile and whippy in an up and down fashion that I really don't see any discernible trend or can make any judgment as far as which way it's going to go up or down. So unfortunately, you're not going to get much help, or your listeners are not going to get much help in regard to the dollar yen, except to possibly say that it's when the stock market rallies, the dollar yen tends to go up, and when the stock market sells off, it tends to go down, and that's a result of things like sterling yen and euro yen sort of following that Pavlovian trade that they have been doing for quite some time.
All right, Greg, if you don't like the yen and the dollar, I'll ask you about euro instead.
Okay.
How about that? All right.
That's fair.
Well, the Eurozone's recent economic data, like the German GDP, has really poised them for a recession. What is your strategy for the euro? Is it another case of who has the most bad news throughout the day?
Yeah, well, it could be, but also some technicals are coming to play into the euro here. Looking at a daily chart here from September, we came down quite from 148 level down to the 122 low. Since that time, 122.80 low or somewhere around there. Since that time, the market, as you can see, has been moving up and down, up and down. The different colors in the candlestick charts represent up and down days, and I've outlined 3 points. These over this whole time period, there's only been 3 times when the euro has gone up in 2 consecutive days. The rest of the time, either it's been up and down or it's been down, down, down type thing. So obviously, the trend is down in that currency pair, and the up days are certainly few and far between. Today, however, would be the 3rd up day in a row if we're able to stay above the 129.50 level into the close. And this might give some impotence for the euro bulls, I guess, or for the dollar bears, depending upon which way you want to look at it, to push the market even higher from its current levels. A normal correction might take the euro up to the 132.90 level, which represents the 38.2% retracement level on that chart. It also is a high around the October 29th day. We reached a high around that level. So this would be a target level. If we can maintain a positive bias today at above the 129.50 level on a closing basis, then I think we have the potential to consolidate further and perhaps move up over the near term. So I'm somewhat objective to the upside as far as the euro versus dollar.
All right, Greg, and before we let you go, the pound rebounded earlier after they had a rally in their equities, but we've seen them fall off a bit. What is your pound strategy?
The pound actually got hit a lot harder than the euro on the move down. And again, I give you a picture in the daily chart. We moved down from July from over two to about the 140s and 146 level or something like that as far as the pound sterling, and that's quite a major move in that currency pair over that short time period of. Since then, we've sort of consolidated, moved a little bit higher. The 152.65 level was an old low going back into October. We're currently we're currently above that level at 153.74. This is a positive development for the pair, and I think that as long as we can stay above the 152.65 level, we certainly have a chance to make a greater correction to the upside. Again, it's based on the fact that perhaps there's a little more dollar weakness, because certainly in the UK they have a weak economy as well, and they're looking to cut rates and describe the economy as the worst in decades and don't know how to really react to it. But certainly, when we're kind of doing the same thing from a fiscal and monetary standpoint here in the United States as they are over there. Depending upon how the wind blows, we might get some more dollar bearishness, which would give a boost to the pound versus the dollar and allow the correction to continue to the upside a little bit.
All right, thanks for joining us today.
Thank you for having me.
This has been your New York Forex Market Buzz with Greg Michalowski of FXDD. I'm Kathleen Reddington. Join us later this afternoon, 4 p.m. exchange, right here on ForexTV.com.